just in the last couple weeks, there's been some very interesting China stories out with good research proving that China's credit bubble is really bad, getting worse, and China is not deleveraging. As the talking heads that they march out on, some of them march out on TV, or people who are not doing good research are claiming, it's a lot of evidence that China is not deleveraging at all. So as you can see here on your screen, this is the first piece of evidence. This is data compiled from Appletree Capital. They're a global macro research money management firm. They're using data from Bloomberg. They have that China is now using 7.68 units of credit for 1 unit of GDP growth. And if you count the bad debt, according to their estimates that China is not counting, it is now 9.74 units of credit for 1 unit of GDP growth. Not sustainable. Clearly misallocations of capital, trillions and trillions of misallocations of capital, definitely a credit bubble, definitely a real estate bubble. I don't know timing on this when this is going to end, but it's not going to end well. I wish more people at the Mises Institute would cover this more. My buddy Daniel Akai, he's not a full-time Mises Institute employee. He's a money manager. He's writing books. He's traveling all over the world, educating people. And I think he's a part-time economics professor. My buddy Tho Bishop, shout out to Tho, he is writing articles about this, but I wish more Austrian school economists at the Mises Institute would cover this. So there's been a lot of data that's been coming out of China, a lot of very interesting stories too. So recently, just in the last couple months, if you haven't paid attention to my videos, in September, we had a warning from Premier Li that GDP growth was not sustainable above 6. More recently, we had Xi warn that it wasn't sustainable either. He said that the Chinese government has to watch out for not just black swans, but I think he also said gray rhinos. I'm not really sure why he talked about gray rhinos, considering what the animal rights problems that rhinos importing rhino horn and stuff. I'm not sure why he mentioned that. So I guess he doesn't care about being politically correct. He is running China, right? He is a billionaire probably. So some of these stories, some of the evidence that's coming out, one of the things that's coming out, first of all, just in the last week or so, China has been injecting massive amounts of capital injections that a lot of people are not covering. Their central bank injected 200 billion. This was from Thursday of last week. 200 billion yuan to boost liquidity, keep the rates unchanged. China's central bank extended 200 billion, which is about 29 billion approximately. The exchange rate is under control now. The Chinese yuan to the dollar, it's back down around 7. The last time I looked at it was 7.03 Chinese yuan to the dollar. So it's not going crazy. However, there is still really bad stagflation, higher and higher pork prices. I've heard chicken prices are also going up from different sources. And you're going to find out with some of these. I'm going to play a couple audio clips too from research. One of them is going to be from this really good interview with Leland Miller, the head of the China Beige book. He lives in mainland China. He hires people to do boots on the ground, extensive research in mainland China, covering private Chinese businesses. And Real Vision TV just released his interview that was behind the paywall about a month and a half, 2 months ago. That just got released in the last couple days for free. So I'm gonna play a clip of that for about 6 minutes or so. I think it's very interesting. But first, let me talk about some of these stories. So China has been injecting a lot of liquidity just in the last couple weeks. They're also doing a lot of repo. There's a new repo story that dropped earlier on Monday. So the repo story was, let me see if I have the right article up. I have so many articles open. Let me see if I find the right article. Okay, so here it is. So China delivered another small dose of token monetary accommodation on Monday. The PBOC cut the 7-day repo rate by 5 basis points to 2.5%. It doesn't sound like a lot, 5 basis points, but it was the first cut since 2015, and it's the lowest the repo rate has been since 2015, and China had a lot of problems in 2015. That's when the reserves, the foreign exchange reserves, they lost $1 trillion. It went down from 4 trillion officially to 3 trillion. So it was a surprise. On Friday, also, They injected a surprise 200 billion yuan in one-year liquidity. The move was not tied to maturing loans, came on the same day that the second of two targeted reserve rate cuts went into effect. So they're trying to be dovish with the reserve rate cuts, freeing up an additional 40 billion in liquidity. Credit growth has, in some of the economy, has collapsed, but overall they have a credit bubble, and the positive returns of credit, the economy is becoming super saturated. The credit bubble, at some point, it just becomes each additional unit of credit is not going to get a good return on investment. You're starting to see enormous misallocations of capital. So the People's Bank of China, on Thursday, like I said, they injected 28.60 billion through its medium-term lending facility. Actually, it was a Friday, excuse me. The second time it has done so this month while keeping the lending rate unchanged. The move to add, they actually just changed the lending rate again on Monday, yesterday. So last week they didn't change the lending rate, so they're being more and more dovish. They're injecting more and more liquidity. They also added a lot of repo since January of 2019. Now, it's not to the levels of the U.S., but the Chinese banking system has an enormous amount of financial assets. There's an enormous amount of credit. For perspective here, China's GDP is, the full year 2018 GDP was around 14.2 trillion, I believe, and they have over $50 trillion of credit, according to Kyle Bass in their economy. And Kyle Bass just did a great interview. I highly recommend listening to it. That just came out from Dmitry Kofinas at Hidden Forces. I'll put a link to it after the show's over. Absolutely great interview. I finished it a couple hours ago before I went to the gym. I wanted to listen to it. There's a lot of very interesting tidbits in there that he had not revealed before. It's right up there with his American thought leaders from the Epoch Times interview. Absolutely great. A lot of interesting stuff. He even explains how a dollar peg works. So if you're not as sophisticated and you don't understand what a dollar peg is or currency peg and how they almost always eventually break, then he goes into it. Okay, so a very interesting story that I saw last week was that the New York Times actually found out that Ruzhou, this Chinese city, was so in debt, so many financial problems that Ruzhou, hopefully I pronounced that all right, that they were asking their own hospital employees to max out on borrowing for a hospital. So I have to read this. Ruzhou, a city of 1 million people in central China, urgently needed a new hospital, their bosses said. To pay for it, the administrators were asking healthcare workers for loans. If employees didn't have the money, they were pointed to banks where they could borrow it and then turn it over to the hospital. That is nuts. Ruzhou is a city with a borrowing problem, an emblem of the trillions of dollars in debt threatening the Chinese economy. Local governments borrowed for years to create jobs and keep factories humming. Now China's economy is slowing to its weakest pace in nearly 3 decades, but Beijing has kept the lending spigots tight to quell its debt problems. I don't agree that they've kept the lending spigots tight. I will play the clip from Leland Miller at China Beige book that says the exact opposite. So this is repeating a false narrative from the Chinese government that they're keeping the lending spigots tight. Increasingly, these deals are going sour as they did in Ruzhou, and the loans are going unpaid. Lenders have accused 3 of Ruzhou's hospitals and 3 investment funds tied to the city of not paying back their debts. Local officials have long used big spending to keep the economy growing. So this is what an Austrian school economist would call massive central planning, massive misallocations of capital. Clearly, it's a credit bubble. Now, we don't know when the credit bubble is going to pop. That's the thing. We don't know when this credit bubble is going to pop. The currency for now is not in any more problems. The currency is not running away way above 7. Like I said, they've taken through probably market manipulation and currency intervention. There's actually articles that came out recently last week by Olga Kotaga from Reuters, and she wrote a very interesting, easy to understand article about how much foreign exchange swaps. So these are very similar to these dollar forward swaps. Remember, I've been talking about those. Kyle Bass has been talking about those. She explains what an FX swap is, how much does a swap cost, how a swap works in the article, what are they used for, when they were first started, and how they've exploded in usage by large banks and central banks and governments to get access to currency that they can't earn. And recently, also a couple days ago, Wall Street Journal put out another article. This is from their daily one-shot blog, and there's a brilliant chart from Alpine Macro. And in that chart, they show that China now has, according to their research, $2 trillion in foreign dollar-denominated debt, and that China is using an enormous amount of their FX reserves, foreign exchange reserves, or dollar reserves to deal with their dollar-denominated debt. According to this chart from Alpine Macro, China is using 2/3, or about 66%, approximately, of their entire foreign exchange reserves to handle their dollar-denominated debt. And so this would confirm what I've been saying for months now, that China is rationing dollars, and they do have a dollar shortage, and they cannot bail out everything in the Chinese economy that has dollar-denominated debt. So they're being selective. They're being selective about when to import copper from international metals markets, or when to import oil from international metals markets, or when to import gold from international metals markets. This, I highly recommend this great article about foreign exchange swap volumes and how they've exploded. They've exploded in amount in just the last couple years, according to this Reuters article. So this ties in with China. China's one, according to Kyle Bass, one of the worst at the amount of forward dollar swaps. And China has done this because they need access to dollars, and they did not want to blow through all their reserves. This started China's derivatives position with these forward dollar swaps. It exploded in 2015 because China had $4 trillion officially in reserves, and in only 12 months, China went down to $3 trillion. So they blew through a full $1 trillion in reserves in only a year. And at that pace, they started getting worried that they were going to blow through a lot more than just the trillion. So let me play this clip first. Actually, I'll read this article now, and then I'll play the clips in a little bit. I have a couple more clips. So foreign exchange swap volumes have risen in the past 3 years to account for nearly half of the entire foreign exchange market. Bank for International Settlements data shows. Wow, it's an explosion. So in only 3 years, the amount of swap volumes has exploded. Foreign exchange swaps have emerged from the dark corners of the derivatives world. They are attracting wider investor interest. So some now fear that swaps could be a catalyst for market disruption, possibly as soon as the end of 2019, if U.S. banks cut back lending to meet cash reserve rules. What is an FX swap? An FX swap is a foreign exchange derivative traded between two parties who simultaneously lend and borrow an equivalent amount of money in two different currencies for a specified period of time, agreeing to exchange back the money at a specified foreign exchange forward rate. This is until one of the counterparties can't pay back. So this is done until one of the counterparties, let's say Deutsche Bank or HSBC Bank, made some really dumb loans to Chinese banks or the People's Bank of China directly, and all of a sudden their counterparties can't pay them back. This could be what is causing some of the problems in the repo market. I believe, my humble opinion, that it is more than one bank causing problems with the repo market. It's not just one bank. There are also cross-currency swaps, which in essence mean the same thing, but these are interest rate derivatives. Their structure is different, and the money is exchanged back at the same foreign exchange rate derived from the FX spot market as at the start of the contract. Borrowing costs in FX swaps are very closely linked with those in the cross-currency swap market. So how much does a swap cost? At the heart of the FX swap contract is the basis, essentially the additional cost or gain of transacting between one currency to another. And dollars are especially in demand because the amount of dollar-denominated debt outstanding has exploded, more than doubled according to Bank of International Settlements data in the last decade. Why? Everyone was betting the dollar, that the Federal Reserve would continue devaluing the dollar rapidly, doing massive QE, and they did not see a dollar rally coming. And the dollar rally that has happened has really caught off guard all these emerging markets and China that have a lot of dollar-denominated debt outstanding. The basis is indicative of supply-demand balance, one currency versus another. Euro-dollar swap, the basis is premium borrowers have to pay to get hands on the U.S. currency. The lower the dollar supply, the more negative basis becomes because dollar liquidity has been shrinking since 2008. The basis has been widening as a result, boosting the premium. Also, let me add that the other problem for China is that their GDP is falling, even the official one that China reports, while their credit has been growing. So that's a big problem, and that's why you're going to get more units of credit required for less bang on your buck, less units of GDP for each unit of credit. So they're throwing more and more credit into the economy and getting less and less units of GDP than in the past. And this all goes back to Keynesian economics, the Keynesian multiplier. It's all bullshit. Because Keynes would say, oh, we'll just borrow it and we'll invest it. And Keynes was adamant for a while that there could be a 10-fold multiplier. He said stuff like this. Of course, he would also renege. He would change his mind. But at one point, when he was younger and Keynesian economics was just becoming like really cool and fashionable, he was adamant that there was a 10-to-1 multiplier, where if governments borrowed, they could get 10 times the GDP growth for every dollar they borrowed. He was adamant that there would be a big multiplier. It has proven not to be true, like a lot of things that Keynes has said. Okay, what are these currency swaps used for? Foreign exchange swaps. Swaps are used to hedge currency exposure, speculate on the direction of a currency, and increasingly now for access to foreign currency funding. That's the key there. Foreign currency funding. So if you are short dollars, if you have a dollar shortage, if you're rationing dollars, you're going to go play in the derivatives market to get access to those dollars because your companies are not earning those dollars the old-fashioned way. European banks lack deposits in dollars as well as dollar-denominated collateral to access other lending markets such as the repo or purchase agreements, so they tend to often use the FX swaps to borrow dollars to pass on to clients. A common reason to employ a currency swap whose duration ranges from 1 day to several months is to secure cheaper debt. Well, it's only cheaper dollar-denominated debt at first, but then if the dollar rallies, then they're in trouble. So the rest of the article talks about the history of these foreign exchange currency swaps. I'll put the link to that. Let me play now this 7 minutes or so from Leland Miller, China Beige book. Some really interesting things in here talking about the China's Q3 2019 GDP numbers, his analysis, boots on the ground, surveying private businesses in China, and then also China throwing the Chinese government ordering the state-owned enterprise banks to throw credit at people that shouldn't get credit and basically bailouts with credit.
I'm Leland Miller. I'm CEO of China Beige Book, and we are the only large-scale private data on the Chinese economy. We track growth trends, we track inflation, we track the jobs market, and most interestingly, we track the credit environment, which is not just formal banks, but also the shadow banking system. So we track who's accessing capital, what they're paying for that capital, and what they do with that capital once they get it. And these are some of the most interesting lenses into the Chinese economy beyond simply aggregate growth data.
What differentiates China Beige Book?
Well, we're the only large-scale independent data. So all these other leading indicators you see, data troves that people present to you, they're all derivatives of official data, which means they're derivatives of the story that Beijing tells you and wants you to know. Now, Beijing has an economic narrative, but they also have a political narrative, which dictates how they term everything. So if you're only looking at official data, one, you're getting very lagging information. You're not getting real-time data the way we present it. But you're also not getting the real story. The Chinese are very invested in having stability. They don't like big dips. They don't even like big accelerations because that means they have to acknowledge the dip in the first place. So it's very important to have things outside of Beijing's talking points in order to understand what's going on and how to forecast potential problem spots.
How does China Beige Book collect Chinese economic data?
Well, we have a nationwide data collection platform. We have, in the last several years, ensured that this is entirely electronic. We track thousands of businesses, over 3,300 Chinese firms. We track them across the entire geographic expanse of China, broken down into 8 regions. We track 7 major sectors. We track 34 discrete subsectors. And then we take and slice and dice that data by private state, by firm size, so micro, small, medium, large. We track Hong Kong-owned versus Chinese-owned versus American-owned companies, and we just get every different shade of the companies, so we're able to know exactly where growth is and where it may not be.
What does the data suggest is happening now?
The third quarter was the worst quarter of 2019 in our data, and it wasn't even close. We saw almost all our headline metrics fall. We saw almost all our key sectors fall. Manufacturing was the worst of these. You saw revenue and profits and pretty much everything that had been going relatively stable for a while fall the third quarter. But you also saw some even scarier trends. Borrowing in the sector, borrowing in the manufacturing sector is at an absolutely sky-high and unsustainable level. We started to see it pick up in 2018. It's accelerated through 2019, but now we're at a level in which over 30% of manufacturing firms are borrowing every quarter. And the way we break that down is that either you've got, over the course of 3 quarters in 2019, every firm in manufacturing has borrowed, or you've got 30% of firms borrowing every single quarter. Now, they're both bad news, and it's very problematic to look at this because this is a sector that should be getting less capital, that should be slowing down, but that's something that the Chinese are very, very worried about. And so there's an enormous amount of policy support being pushed into the sector, which we can see through our credit metrics.
Okay, let me stop it right there. So he contradicts what the Chinese government has been saying. The Chinese government in the official data is saying the credit is not going in anymore, that China's deleveraging, and he just contradicted that. He said they're throwing more and more credit and it's not helping. He also basically just said that China is bailing out manufacturers. And I've heard anecdotal stories for over a year now. I was dating this girl, because she's not in my life anymore. I was dating this girl last year, and she worked at a job in Baltimore, and she worked for a large shipping company, and she was spending 3 months of the year traveling through mainland China, including Guangzhou a lot of time, and she was negotiating with the factory owners. And the factory owners, you know what? They were either producing inventory and piling it up, or they were they were shutting down the factory because there was no demand for a lot of the stuff that they were producing. So China is bailing out factory owners. There's a lot of other stories talking about this. There are municipalities. Remember, I covered in the last couple of weeks that there are municipalities in China that are deadbeats, that have enormous amounts of bills outstanding, and they're not paying their bills, and they're being sued. There's $200 billion worth of IOUs, and that was months ago, probably even more than that, going throughout the Chinese economy. China's getting hurt very, very badly by this trade war. Things were getting bad before Trump put the tariffs on, but the tariffs have made things worse. So let me continue now. He starts talking about more and more with problems with credit, the Chinese government telling the banks to give out more loans. Continue now for a couple more minutes.
What has changed in the data?
That's right. So let's go back a year. About a year ago, we were seeing a Chinese economy in 2018 which was doing better than people thought, partly because tariffs were coming and people were front-loading purchases. But in the third quarter, in our flash data, we saw export orders and domestic orders, but new orders just crash. And we saw some real struggles in manufacturing. Manufacturing sector in the third quarter of last year looked really weak. The rest of the economy looked okay, but the fourth quarter, manufacturing took everything down with it. So you saw every sector worse off. Every region in China worse off. Every headline metric worse off. It was the worst data that we've seen, other than the end of 2015, in the history of China Beige Book. And I think at that point there was a decision made in Beijing to cushion the economy at all costs. That they could not divine President Trump's intentions on the trade war, but they couldn't take any chances. They needed to unleash some of the credit that they've been holding back, and you saw that going right into 2019. So the first quarter of 2019 was a remarkable recovery. We saw it in our flash data in February. It became consensus when public data showed that the first week of April, maybe a week before. And what was so amazing about this was not just the fact that there was more credit or there was more borrowing, but it was the type of firms that were borrowing at the time. We saw typically disadvantaged firms like private firms and small, medium-sized enterprises out borrowing other firms in the economy. So we saw rejection rates at the lowest level in China Beige book history. Clearly, the message from Beijing was get these guys credit, keep them afloat at all costs. And that was Q1. That caused the recovery. Q2 was something very interesting because then we saw the return of shadow banking. And so in addition to a still very active credit provision regime in the second quarter, we saw a return of shadow banking. And the last 2 quarters, second quarter and now third quarter, we've seen the highest share of shadow banking as a percentage of overall borrowing that we've seen in the entire history of China Beige book. So shadow banking is back. Now, what's so interesting about the third quarter, the second quarter, well, just to look back to the second quarter was interesting because you actually saw a more resilient economy than what was being talked about. The headlines were all about 27-year lows in GDP. We weren't seeing anything good, but we also weren't seeing the bottom fall of the economy like a lot of people were talking about. We saw a Q2 performance that was very stable from Q1. Now, the interesting thing about the third quarter is that despite the continued provision of this much credit, 6-year highs in corporate borrowing, the highest bond sales we've ever seen, going up 5 straight quarters, despite the resurgence of shadow banking that's at the highest levels we've seen in the history of the survey, the economy still turned downwards, and every sector still turned downwards. And so it's quite amazing. This could be an inflection point for the Chinese economy right now, because what they have been doing up to this point, which has not been the big infrastructure investment of 2016. All our construction subsectors are looking very bad right now. They are not juicing the economy the way they did 2016. But what they are doing is providing an enormous amount of credit to firms, including firms that don't merit that type of credit access. And they're keeping the economy going. But in the third quarter, it wasn't enough, and things slowed anyways.
Okay, so law of diminishing returns on credit, massive misallocations of capital. China's throwing credit to manufacturers over capacity, keeping these manufacturing companies and factory workers employed when probably these factory owners should be bankrupt or they shouldn't be producing anything because there's not the demand for the goods. And I've also heard stories anecdotally from additional sources in China that are now reaching out to me through the podcast. And they're telling me that in the cities they live, that they have seen factories where the factory will take a month off and not produce because there's no demand. So the factory will go a month of production, take a month off. Month of production, take a month off. So there is a lot of misallocation of capital, a lot of problems in the Chinese economy. A lot of it has to do with credit. Now, people are asking if China can bail out loans. China can deal with the RMB debt a lot better than they can with the dollar-denominated debt. The big problem for China is dollar-denominated debt. They can deal with the RMB debt in their own currency a lot easier than they can with the dollar-denominated debt. That's where the problems are. And there's a lot of dollar-denominated debt. There's people claiming there's no dollar-denominated debt or small amounts. It's not true. There's research coming out saying that China's dollar-denominated debt, I just talked about it earlier in the podcast, was $2 trillion recently, according to a Wall Street Journal article that cited Alpine Macro, $2 trillion dollar-denominated debt, and that China was blowing through, I think, 2/3 of their reserves to deal with the dollar-denominated debt, according to that research that was recent. There's also new red flags in the Chinese banking system. I heard this on a recent video from Winston Serpensa. He is a very popular China blogger. So he lived, if you're not familiar with him, he lived in mainland China for 10 years, and I believe he just moved out. His wife is Chinese. She was a doctor in China. She got scammed in a peer-to-peer lending scam. Unfortunately, it's very common in China, and the regulators are not taking care of things. So when there is one of those scams, China's supposed to have these bureaucrats and regulators, and they're not doing anything to help in any of those scams. So let me play this, what Winston has to say about the Chinese banking system now. This is in his video that came out a couple days ago. China's negatives now outweigh the positives. And if you go and watch his early videos, he used to love China. He used to travel. He travels all over China. He has documentaries about it. But he said really over the last couple years, things, especially 4 or 5 years, things have changed a lot. Mostly once Xi became emperor. Well, before he officially became emperor for life, Xi started making a lot of very totalitarian radical changes. But this particular clip is about the Chinese banking system.
One thing I absolutely loved about China when I came to China, I even got a video about it, is how easy it was for me to open up a bank account. You know, this is way before the days of WeChat or anything like that. And, you know, having a bank account is something you need if you're going to be paying your rent, paying your utilities, things like that. And I opened several just by walking into the bank with my passport, going to the counter, filling out a form, like something like 10, 15 minutes later, I'd have my debit card. Of course, you can't get a credit card doing that, but you could get a normal savings card, you know, a debit card. You could walk out within 10 or 15 minutes and you had your bank card in your hand, which is something very different to the West, where you kind of have to go into a bank and proof of residence, all that kind of nonsense, and then later you get your card in the mail. It's very, very annoying. But in China, I found it very efficient. And I found the banking system very efficient because at the ATM, you could just put money in to the ATM. It counts it for you right there straight away in your bank account, which is different from where I'm from. I know that around the world it's changed these days. A lot of ATMs can take cash. But for me, I thought this was fantastic. Getting money and depositing money, you know, from the bank, it's very easy through the ATM system. However, again, this convenience and all of this has changed. China is now, because of the economy going down, they are putting massive stops to any US dollars going out of China. So there's a couple of things I want to talk about here. Number one, opening a bank account is not as easy as it used to be. Now you need to have a certain type of visa. You need to have, you know, obviously your residence permit or your temporary residence permit and a bunch of other documents before you can even go in to open your account. So in the past, where you only ever needed a passport to walk in there, they did ask you to write down your address, but you didn't need to show them some kind of proof or anything. Those days are long gone. Now it's a lot more complicated and difficult. So, for instance, just an example, when my sister visited me in China.
Okay, there's more to the video. I'll play the rest later. So he's just talking about how the Chinese government and the Chinese banking system, probably because the Chinese government ordered them to, is trying to block people not only with the capital controls and getting all their savings out of China, but specifically if you have dollars in mainland China, they want to block those dollars from leaving. So this goes totally against the narrative, the false narrative from the gold community that China is abandoning the dollar, going to crash the dollar. It's totally going against that narrative. Someone asked a question in the live chat section if China can use their gold to deal with their dollar problems. And I don't think China wants to sell any of their gold to deal with their dollar problems. I don't think China would, I think, prefer, the Chinese government would prefer to confiscate gold from their own citizens, maybe, to deal with that. But I don't think they want to sell any of their own gold to deal with their dollar-denominated debt problems. They can deal, like I said, with their RMB debt a lot easier than they can deal with their dollar-denominated debt. Omicron 1112 asks, you mentioned earlier that China could get rid of its debt or something like that a few videos back. Yeah, they could get, it's easier for China to deal with their RMB debt than their dollar-denominated debt. Their dollar-denominated debt is immensely more difficult for China to deal with. With their RMB debt, they can just have the People's Bank of China, their central bank, print more. And yes, it's going to cause probably more stagflation in the economy, given the African swine flu. I mean, there's stories, I don't know if you guys have been tracking this with the African swine flu, but I've seen estimates that 70% of China's hog population is dead. I've seen estimates as high as 70. There's also stories that are coming out that dead Chinese pigs are washing up onshore in Taiwan, and that some of the farmers in other countries like Thailand and Korea are so worried that they're going to get their pig herds are going to get infected with African swine flu that they're killing anything that looks like an infection. So this is going to cause a lot more demand on international agriculture markets to import more pork into Asia. There's about, I found about 6 stories on this all over Asia in just the last month or two. And the pig washing up on shore in Taiwan, I think was in the last week. China also had a small bout with the plague. There was a couple people and they had to be sent off to Beijing. But I spoke to someone and that doesn't sound as serious as other people were making it out to be. Like the Western media cover that, but apparently that's fairly common in areas where there's a couple plague cases. The disease hasn't been totally eradicated. There's still occasionally a bout of plague, bubonic plague. So there you have it. You have some more craziness out of China. You have more local governments over borrowing. The hospital story is crazy. The New York Times journalists were doing the story, and I believe they were kicked out of that area. And then you have all the human rights violations that are happening in Xinjiang, where journalists aren't allowed to go, and occasionally a small amount of video or a photo or two gets smuggled out. Thankfully, there's starting to be more coverage of that. So just massive amounts of misallocation of capital. I mean, look, they actually asked their hospital employees to go borrow money so they could build a hospital. Oh my God, it's just unbelievable. Yeah, journalism here in the United States sucks too. That's why people like me have an opportunity here to cover all these governments making all these dumb mistakes. Peter Schiff has said China could get rid of its debt. Never heard Jason say that. Peter Schiff is only partially correct. I talked about the difference between RMB debt and dollar-denominated debt. I have actually never heard Peter Schiff discuss how much dollar-denominated debt has exploded since 2008. It's more than doubled. Dollar-denominated debt, according to the Bank of International Settlements. I did an entire video on this, looking through the Bank of International Settlements report that came out in September. There's over $11 trillion outstanding in dollar-denominated debt. Peter Schiff's not covering that. Doesn't fit his narrative of foreign stocks. Dollar is going to collapse first. Dollar is going to be hit the hardest. Only gold. And the problem with the investing in a lot of these foreign companies, I don't think Peter Schiff's company is doing a good job of this from what I've heard in the past from people who are former Europac clients who have told me some stories, is he doesn't realize the accounting standards of a lot of these foreign companies. So he might have someone look at some of the publicly listed financials of some of these foreign companies, but on a foreign stock exchange, there might be no audits required. Remember the documentary, The China Hustle. Highly recommend that documentary. And Kyle Bass talked in his Hidden Forces interview that just came out about how Chinese companies are given exemptions from auditing, Western American auditing, when they list on a publicly traded stock exchange here in the U.S. And then you have Kyle Bass talking about all the problems with Hong Kong banks. Looks like there's a lot of problems with Hong Kong banks. You have all these people in Hong Kong who want to get out, want to take their savings out. Yeah, I know people have lost a lot of money on with Euro Pacific Capital on the foreign stocks and also gold mining stocks. It doesn't. I got a research report on a mining stock from Euro Pacific Capital in like 2011, and they were recommending it a buy, and I think within like 12 months it was bankrupt. I don't know if they've improved or not since then, but years ago, the research and the coverage was not very good. Oh, thank you for the super chat. Yes, I got your questions today. I didn't look at the email that much. I saw the email right before I went to the gym hours ago. I'll take a look maybe tomorrow. No. No. Tom, they can borrow in dollars. So in another country, a foreign corporation or a foreign bank can choose to borrow in dollars. The US isn't giving them. They can borrow in another currency. They can take out money in another currency, and they're betting that the other currency they take out the loan in will fall rapidly in value while their local currency appreciates, and then they win that way. Then they get to pay back the dollar-denominated debt with a stronger local currency. This would have worked if China's economy kept growing without the credit bubble, if the commodities bull market in copper, oil, and energy had kept booming and commodity prices were high. This would have all worked. And if the Federal Reserve had kept doing QE for all those times and not doing quantitative tightening, and the dollar would not have rallied. No, they don't have to buy treasuries, but if you have dollar-denominated debt, you need dollars to pay back. That's why the dollar is strong. So besides the fact that there's net capital outflows out of emerging markets, you have all this dollar-denominated debt that's increased in amount in the last 10 years, and there's a lot of demand for dollars because people need to pay back that dollar-denominated debt, or at least make the interest payments on the debt so they don't default right away, because if they default right away, they will collapse first. So this is why you have the dollar looking stronger despite the fact that there's repo madness, despite the fact, insane amounts of repo madness, and despite the fact that the Federal Reserve has done 3 rate cuts since July. I think China has a lot of problems long term. And I don't think the Chinese government wants to make any of them. Wants to make any radical changes like that. I think things are going to get more totalitarian, more draconian. The plans that I'm hearing from my top source in mainland China, things could get a lot worse January 1st, 2020. Thank you for being a Patreon account supporter. Thank you for my almost 200 Patreon account contributors. Really helping me out. I appreciate it. I would have to differentiate. It depends on which commodities. The supply-demand fundamentals, less stuff, more meaning. The supply-demand fundamentals for each commodity is completely and totally different. So, for example, the supply-demand fundamentals for nickel, I covered this a couple months ago. I thought the supply-demand fundamentals for nickel and cobalt were good. I did not like the supply-demand fundamentals for lithium. Why? Because one of the largest lithium producers came out a couple months ago over the summer. That's Southern Química de Chile, SQM, so Sarah Keish Michael, on publicly traded stocks. And they said in their conference call, they said the lithium market is drastically oversupplied. So it depends on you can't say all commodities are going to be in a bull market. Those days are over. Okay, China has overcapacity. They misallocated capital, trillions of it, massive overcapacity in their factory. Peter Schiff says they're producing stuff. I would argue that a lot of the stuff China's producing is not, there's no demand for it or little demand for it. The demand is falling and it's wasteful. They're just piling inventory up. It's essentially Keynesian ditch digging, but with factories. So these factory workers are getting paid. The loans, the manufacturers, the factory owners are getting bailouts. They're getting credit and bailouts. Either they can't pay the loans. The girl I dated last year from Baltimore, well, she was working in Baltimore for a large shipping company, and she lived 3 months out of the year traveling throughout mainland China, negotiating with factory owners. And she was telling me her negotiations with the factory owners were really, really easy because they were desperate to sell. They had way too much inventory. They were desperate to get rid of stuff at almost any price. And she asked them, like, why are you willing to sell so low? And they're like, well, right now we're getting bailouts. Some of them were getting bailouts directly from the Chinese banks and the government. Yeah, thank you for the super chat, Veritas. Thank you for the super chat, RR. It's even, the stuff going on with the Uyghurs in Xinjiang is even worse. There was, on China Uncensored, there was a, they showed it like a 2-second clip of a video, and these kids, like China says, you really have to listen to the Kyle Bass Hidden Forces interview that just came out. Some of the stuff in there is incredible. It's about an hour long. The free version. I think there's more, like even more content and insights in the behind his paywall. But yeah, China Uncensored they spoke to the Italian journalist whose source got him a photo of where these kids go to school, and it's not really a school. They showed a tiny clip with a photo, and these kids are going to school in a prison. And then there was a story recently that was unbelievably shocking. You know, that the organ harvesting and all that stuff it's unbelievable. I mean, if I didn't see all the evidence and all that stuff coming out, I don't know if I'd believe it. But yeah, the stuff in Xinjiang is insane. But there's a lot of sources coming out confirming it. Oh, the other story I was going to bring up was the one where if the Uyghur woman, the Western Chinese Muslim woman, if their husbands or boyfriends were sent off to the slave labor camps, that the Chinese government assigned Chinese men to sleep in their beds. That was a new one I saw in the last week or two. Okay, well, I think I covered pretty much everything that I wanted to cover. I will put articles, links to these articles in the information and description section of the video. Again, thank you to my almost 200 Patreon account contributors. Hopefully it'll be well over 200 by the end of this year. Make my life a lot easier. Then I could just focus on doing content like this. And thank you to my dozen or so monthly PayPal contributors and the people throwing me a tip once in a while. It's much appreciated. There's a lot of crazy stuff going on. Look, my whole point with this, I criticize all these... If you're new to my channel, I criticize all these governments. The U.S. is doing a lot of dumb things right now. Jerome Powell just testified before Congress this past week. If you want to see something funny, if you have a twisted sense of humor like me, dark sense of humor, go watch Jerome Powell's congressional testimony where the brave congressman from Texas asked him about repo. And Powell was lying. Powell was making it like, oh, you poor little guy. You don't understand. Leave it to us sophisticated PhD economists. We have this all figured out. You know, he was just lying through his teeth. It was all bullshit. But China's doing repo too. Emergency liquidity injections also from China. So all these governments are all doing crazy stuff. I just saw a new research report that came out. I didn't see this until recently, but this report came out in 2011, and it says that the Federal Reserve really created 26 trillion, over 26 trillion. From Freedom of Information Act request documents, there was over 250 pages. Might have been over, actually it was way over 250. Might have been 25,000 pages of data dump in a Freedom of Information Act request. And Bloomberg got it. And people sifted through the data and wrote a report. It was a university. And they said that like the European Central Bank got 8 trillion. And they were going through the list there. And they estimated that it was like 26 trillion the Fed had to give out in currency swaps and interest rate loans and interest-free loans in 2008 and 9. Good question by Old World Order. Why does it matter who crashes first? Because then it will create a different chain of reaction. It will create a different chain reaction. So it matters mostly to hedge funds and the government officials what collapses first. In my opinion, what collapses first, that means that whoever collapses first has the least amount of power or say in what the next global financial system is. That would be my opinion. So whichever country collapses first, they will have less of a say at the voting, at the round table, whatever, Bretton Woods, whatever the next major conference. There's going to be at some point some type of Bretton Woods system. So that would be my opinion. So let's say if emerging markets collapse first, they would have less of a say at the next Bretton Woods. Or if European Union collapses first, they would have less of a say at the next Bretton Woods. Or if Japan collapses first, they would have less of a say at Bretton Woods. And this is why the U.S. is printing so much. I think the U.S. believes this. But Kyle Bass has said that the U.S. is being saved for last. As of now, I agree with him. As of now. We'll see if that changes. Pot stocks? All I have to say about marijuana stocks is, guess what they were using? EBITDA. Big red flag. What did I tell you guys? I've said it for months now. If all an industry, a company in an industry, if all they talk about is EBITDA this, EBITDA that, red flag, red flag, red flag, red flag, red flag. And that was the pot industry. Revenue growth only. Talking about EBITDA nonstop. In my opinion, if the U.S. is saved for last, that means the U.S. would be bailing out emerging markets. They would be able to negotiate new trade deals for that or get other bargaining power. Whoever the U.S. bails out, they will secure votes. They will get them on board with whatever the next system is. That's why I think the U.S. wants to be last. If the U.S. is saved for last and they save other countries and other governments, they will call in their marker, they will call in the favors in, which means that they will have the votes they need on the next Bretton Woods for the next system. That would be my educated guess based on studying financial history and the stuff that occasionally comes out that I hear from sources. Okay, my voice is starting to go. I'll just put all the articles I discussed and some of these other videos in the information and description section. I did not get to talk about how Jack Ma says the economic Cold War could last 20 years and how a former minister of China, I guess, says that there's a larger financial war coming. But I mean, I've covered a lot of these topics about the trade war, so no surprise if you paid attention to my channel for 6 months or a year now. Been providing a lot of updates on this. There's no surprise about any of the trade war stuff. Any of the updates that we're getting. No surprise, China's hoping that Trump does not win in 2020. That is probably China's best bet. Hoping that Trump does not win in 2020. And that a soft Democrat, China will be able to either bribe or coerce or, I don't know, get a more pliable, less resilient Democrat to go back to the status quo of what things were before Trump started putting the tariffs on. Then get those charges against Huawei dropped, get them removed from the entity list, get the charges against the Huawei CFO dropped. That's what China really wants. Yeah, I think Trump has as of now, Trump still has a good shot. Well, the Chinese government already owns Joe Biden. They gave his son, who has no experience in finance, his son got $1 billion to invest in private equity. Let me tell you, raising $1 billion, normally, not easy. Unless you're Joe Biden and his son, apparently. He doesn't even have a background. He doesn't even have background to be an entry-level analyst. The son couldn't even get an internship on his own merits without dropping his daddy's name. He couldn't even get an unpaid internship at a Wall Street investment bank. That's how bad the son's credentials are. And the Chinese government just straight up gave him $1 billion to manage. I wonder what those SEC filings say. I wonder if he's lost it all already. Like Chelsea Clinton's husband. Chelsea Clinton's husband tried to be a big shot, and he leveraged up and bet against Greek bonds, and he lost a lot of money very quickly. Okay, well, that's it for now. Everyone have a nice rest of your week, and there will be more content. I am working on some interviews. I actually just spoke to someone close to Kyle Bass, and we'll see if I can get an interview done, an interview agreed to in the next couple weeks. I am trying, though. People keep asking me, are you going to get it? Are you going to get it? I've been talking about it publicly for 6 months. I am trying. It's not easy. He is a billionaire. He just did another podcast interview of similar content and quality to mine. So hopefully, I know he's listened to some of my interviews, and I know he's liked them. So hopefully I will be able to get an interview with him soon, and I will ask him tough questions.